Man, we are so excited that you are here and going through this course, Field to Profile. It is the culmination of lots and lots of years of trial and error and struggle on my part and on the part of those that have spoken to this course to get to where we are now, which is really a resource for those who would want to be active in markets, who want to have a foundation that they can build on, and one that's built so that they can win, and one's built so they can last. And these 12 modules that you're going to go through over, however long it takes you to get through them, are going to methodically build that foundation for you. And we're just so excited for you to be part of this, and for the outcomes that it's going to bring about in your own approach to markets, as a trader or an investor. And we can't wait to get started. So let's jump in. First, and this will be a recurring theme as we go through this course, is just a recognition that any time that we go after opportunity, there's risk. Whether that is a business opportunity, an arbitrage opportunity, in this sense, a trading or investing opportunity, there's always risk that we want to be aware of. Because trading and investing can be so compressed in the cycle of risk, you just have to know what you're getting into. We're going to do our best to try to set the stage for what that risk looks like as you're going after these opportunities, but always be aware of that. Always check and see whether that's aligned with your values and what you're trying to accomplish. By way of introduction, this is me, and just some background on myself and where I'm coming from and where this course has come from. I'm like a lot of traders who want to be involved in markets at a high level. I started as a retail trader part-time while I had a full-time job, and got involved in markets while I was in grad school, really kind of by chance, and was just enamored and hooked by the challenge, and saw it as an opportunity to beat the benchmark in my savings account or CDs or mutual funds or whatever. And I had friends that were playing video games. I thought, if I was going to spend some time working and developing a skill rather than playing video games, how about I learn on a skill that's going to actually benefit my family and benefit me and be rewarding. And so I've been pursuing markets for 10 years and have transitioned from a part-time retail stock trader to working in the industry for one of the oldest futures brokerages in the United States, and on the institutional side, directing managed futures and working with institutional clients. So I've kind of seen the gamut, and as I look back on my development and even before I was in markets, I was in telecom and worked on curriculum development, really. Everything that I've done has been around taking ideas and making them, make them as simple as possible so others can grab them. So now that I've kind of achieved this level of competency in markets, I just love teaching. And so this course is really meant to take everything that I've unpacked over the last almost 10 years now, and distill it down into a very simple approach, so that the learning cycle for you could be wildly compressed. I have spent thousands of dollars. I've lost tens of thousands of dollars, and lots of time making mistakes and learning habits I eventually had to unlearn to get to a level where I could consistently extract money from the markets. Desiring to do that in such a way for you that we remove that as much as possible. We're not going to completely remove that curve, but we're going to significantly shorten that curve through this course. So let's talk about how this course will help before we get into the first module. First, I just have a question for you as you approach this, is to think in terms of the outcome if it went as you hoped it would go. And people are coming to markets in all kinds of reasons and desires and hopes and dreams, and some of those are very realistic and some of those are not realistic. And before we really dive in, just take a moment and take stock. Maybe pull out a piece of paper and just say, look, if I could wave a magic wand today and accomplish an investing and trading goal in 6 months, what would be accomplished? What would that look? How would I know that I had accomplished it? If you're using the Barbet nomenclature, you would, and you'd bet somebody, hey, I'm going to be at this level in 6 months. How do we know who won the bet? It needs to be measurable in that sense. But what is that goal that you have to accomplish? And that could be just having a level of competence to know what you do want to do and what you want to pursue. It could be that you're actually actively trading or investing, looking for opportunities. It could be across a spectrum. But for you personally, what's it going to be? And if you achieve that, the more important question is, how would your life be different? There's a lot of, dare I say, perspectives around markets and what they are and what they aren't, and around trading and investing that is just completely outside of reality. So people come to markets looking for, in some sense, a holy grail, as if they're going to find some specific system that is going to make them be able to just print money, and it just doesn't exist. And I say that with some caveats. It does exist, but you and I most likely can't compete with that. This is at the upper echelon of the industry, where they have both the speed and the resources to just outpace everybody else. But for the average trader and investor, a holy grail doesn't exist, meaning that you're going to have to do some work. You're going to have to think critically to be successful. Success can be achieved. It absolutely can be achieved. And it's going to start by kind of clipping off some steps. So what is that goal that you would like to have? And then how do you hope that will impact your life? As we're thinking about this course in terms of the specific objectives of it, from my perspective, this is what we're intending to do, is to provide you a quick and effective on-ramp and foundation for active, self-directed investors and traders to work toward their goals. We're going to help you build that to win and build it to last, and we're going to compress that cycle. My perspective is, most people watching and going through this course are smart. If you're interested in markets, you're already separating yourself from the herd in some degree. And you are likely, if you stick along with it and you have a process that can help you eliminate errors, you most likely could be successful on your own. I know that because most of my success came from self-learning. However, how long will that take? And what's the trade-off of having to wait that long to get there is a different question. I know for myself, I spent at least 5 years trying all kinds of stuff that didn't really work before I really honed in on what was adding value and what was not. What were things that were giving me additional skills that I could leverage, and what were things that were actually causing me to diminish my performance? And I think, man, what if I had those 5 years back? What if I could have compressed that cycle of learning from 5 years to a year and a half? What would I have done with that other 3.5 years? That in some sense, that's what I'm doing now. I'm realizing and have for several years the benefit of those first 5 years. So I don't have a whole lot of heartburn about it, but I think, man, there's so many people who want to be active in markets and are trying to figure this out, who spend years and years and years when, man, what if you could compress that cycle? And this course is meant to help you get as quickly as we can to a level of competence where you can then add additional components to your approach and have a degree of confidence that what you add will only enhance what you're doing, not subtract from it. So that's the goal. That's the thing that we're aiming at. We're really looking at placing you in this sphere. And some of you have seen Greg McKeown's book, Predictable Success. But many traders, because when we approach markets, we're approaching them as a business opportunity. We start off and we have kind of an early struggle, or maybe we jump into a little bit of fun, and then after the fun, where we think, oh man, I could just do this, it's going to be easy. We find out that it's not easy. That it does require some effort, and so there's typically a degree of whitewater that occurs. It's kind of shaky. It's not really great, but ultimately, through the elimination of error, through a prudent and a systematic system of approach, you can arrive at what we call predictable success. This is a place where I can actually look and say, all right, I know that I have a skill, whether I lose on that trade or win on that trade, but the cumulative effect is that I'm going to extract money from the markets. This is the arc. Now, once you're here, you want to stay here. You want to continue to refine your system and continue to make sure that you have an edge. Edge does not exist forever in markets. You will have cycles where you find an edge that you can exploit, and then it will be removed. So you're going to constantly have to keep developing an edge and approach that works for you, that works for your time frame, that works for your goals. And we're going to help reduce the trial and error around that, and also land around some specific concepts and principles that don't change, although some things will change. So this is what we're aiming for. We're aiming for this predictable success, and we're desiring to keep you from going off into this treadmill and rut and death rattle where you think, oh, well, I've achieved it, so then I don't have to do anything else. And you ultimately end your experiment in trading because you think that you figured it out and then the market changes. Lots of stories of that where, there's approaches that worked decades ago that don't work anymore. And I've done some work with guys who were very effective on the floor in Chicago. When they tried to move to electronic trading, it doesn't work so well. There was a skill set that was present on the floor that did not translate to electronic trading, so it becomes a challenge. Just like any business, what got you there won't get you there. What got you here won't get you there. The book, some of you may know, from Marshall Goldsmith. However, if you stay on top of it, you keep a keen eye, and you have some good principles that we're going to lay the foundation for, you can stay in this land of predictable success. Now, to do that, one of the things that we have to be able to assess as we're starting has to do with stages of competency and the recognition of where you are in these stages. Because the closer you're aligned in terms of what your perspective is regarding these stages, the better off you'll be. So, for example, if I think, if this is me, there's me, and this is the reality of where I am. So, and there's a delta between them. I'm not going to be very effective, especially the wider this gap is. The less effective I'm going to be, because I'm going to make changes and adjust my approach based on my perception of reality, not what is reality. So the goal is to shorten this chasm as much as possible. And one of the ways to do that is with two tools we're going to look at real quick. First is what we call the 4 stages of competency. So these 4 stages, stage 1 is an unconscious incompetence. This is someone who doesn't know what they don't know. I had this experience in markets, another place in my life where I've experienced this and just been overwhelmed in a sense by what I didn't know, is I had dogs growing up. My whole life, we always had a dog in the house. And then when I got married and had kids, my wife and I got a dog, and we were really struggling with this dog to the point where we were getting ready to get rid of this dog because it was showing some aggression towards our kids. We had young kids. And so we actually, through a friend, reached out to somebody who was one of these dog whisperers, right? And this lady said, hey, money back guarantee, I'm going to come over, and in 30 seconds your dog's going to behave differently. Or it's free. And I was like, well, okay, yeah, whatever. I don't believe it. I don't believe that there's some secret to dogs. I've been around dogs my whole life, so try your best. And man, this woman came over to our house and literally walked in the door, and the dog behaved differently. And I was like, what are you doing? Like, what do you know that I don't know? And through our relationship with her, we discovered that there were ways and approaches that you can work with a dog as a human owner that can actually confuse a dog, that can actually lead them to be more aggressive. And once you correct these things and you're consistent in your approach to them, their behavior totally falls in line. We experienced that. So, what we were experiencing is we had an unconscious incompetence. We didn't know what we didn't know. When you first come to markets, and if you've never traded, or you're just like, I'd like to invest, and that's it. That's all you know. You are at stage 1. You don't know what you don't know. You don't know the products. You don't know the risks. You don't know the strategies. You don't know what works. You don't know what doesn't work. You just know you have a desire that you would like to do something. Okay, this is stage 1. So one of the things to assess for yourself is, am I at stage 1? Do I just have a desire to do something, but I have no competency? I have no framework. I have no practice. I have no experimentation. That's stage one. That's not a bad thing. It's a great foundation if you know where you're at. Second stage is stage two, which is a conscious incompetence. So I experienced this as a trader when after I first started trading, and I did what I would never recommend anybody to do, but I got involved in markets because I had a friend who was buying stock, and I didn't even know how to buy stock. And I said, how do you do that? And he's like, well, it's easy. You go and sign up for this, an account on this website, and they link it to your bank account. You transfer money over, and then you can buy stock. And then if the stock goes up, it appreciates. I was like, oh, okay. And that's all I knew. And I actually, followed this guy into this trade, and bought 200 shares of the stock. It was like $225, $250 a share. A month later, it was $5 a share. So 100% gain in a month, right? And so at that point, I was like, whoa, this is incredible. I want to do this all the time. It was so easy. Surely that I can just do this whenever, right? That's kind of what I'm thinking. And again, that's stage one. I don't know what I don't know. So then as I started trying to find other opportunities and trying to find, well, how do I even identify an opportunity? How do I even identify, I don't even know what stocks there are out there. How many stocks are there? I have no idea. I quickly found out that I didn't know very much at all. And that's a stage two. That's a conscious incompetence. Another way that you know that you're at stage two is that if you know that you've been trying and exploring different approaches and strategies and trading products and methodologies, and it's just not working. This is a conscious incompetence. Maybe you're taking this course because you're not a starting trader, but you've been in markets for a long time and you're frustrated. And I get it. I feel for you. I've been there too. It sucks. And it just feels like, man, am I ever going to figure this thing out or not? Should I just go spend some time doing some other stuff? And I'll tell you, for some of you, the best thing that you can do is to walk away from markets. Maybe the best thing for your life and the best thing for your family and your career. And it doesn't mean that you're a failure. It doesn't mean that. And in fact, sometimes when you walk away from something that is just not going to work, that's a win. And that's another thing that we hope to accomplish through this approach is to know, hey, is trading for me or not? Is this something that I want to pursue or not? And be able to make a clear decision around that. So that's stage two. Stage three is a conscious competence. I would call this a mechanical performance, meaning that you have arrived at a understanding of what works, but it's not instinctive yet. As the dog whisperer was teaching our family about how to work with our dog, she gave us all of these approaches and commands and things to do and things not to do, and we could do all of that, but it wasn't instinctive, and we made mistakes because we didn't, we had to think really hard. Okay, in this situation, what do I do? But we had a framework, and as long as we looked at the reference stuff and we kind of worked out our plan, it worked, and eventually it just became habitual. That's stage four, an unconscious competence. In stage four, you know what works, and you know it so well that you can respond from gut and instinct. And this is really the goal. The goal for somebody who is, really a successful investor and trader in markets is someone who can do it and identify opportunities almost like they're breathing. The people that I was always really enamored around, and when I knew that I was really kind of coming to my own as a trader was when I could clearly just look at a chart, any chart, and I could say, yep, I'm interested in that. No, I'm not, and I knew exactly why I wasn't. At stage three, I could look at it and I'd have to go through this mental checklist, and sometimes I'd miss stuff because I had to think really hard. It was a conscious competence, but it wasn't instinctive yet. So the goal of this course is to get you somewhere between stage two and stage three. We're going to introduce you to lots of initial ideas and strategies and approaches and ways to think, but it's going to require a lot more exploration on your part. And we can help you with that beyond this course, or we're welcome to continue to explore that on your own. I think we're going to serve up to you enough of an idea of where this could go that you can take it from there. But if you're not, we're always here to help. really, we can't get, and I've never seen anybody who's successful can take a trader from stage 3 to stage 4. That last move from stage 3 to stage 4 comes down to you and how bad do you want it and how much do you want to put in the effort to be successful. We can tee you up, but the ultimate success is on you. Another way to discern where you are around these 4 rooms is to, or around these 4 stages, is to use what I call the 4-room model. And why this is helpful is because there are some latent biases and prejudices that we have around what we're capable of and what we're not, that are not, again, always in line with reality. And if you're not clear about what you're capable of or not, when you come to markets, you'll get hurt, and you'll get hurt quickly. You'll get hurt badly. So, you know, one of the things that I always think of is, hey, Claus Jansen came up with this model in the 70s. He's a Swedish psychologist, used a lot in business endeavors. And the idea is every person is in one of these 4 rooms with respect to an endeavor or a degree of expertise that they're desiring to acquire. Which room are you in is always the question. Now, I use this tool a lot, not just in trading, but I do some consulting on the side. And I'll often ask people, and you'll know that one of the things that people will often say is that they are in the renewal room. It's the idea that, you know what, we've identified some issues I need to work on, but it's getting better. It's really getting better. To which I'd say, okay, well, if you're in the renewal, that's fine. How would you know, how did you know that you got into the renewal room? And how will you know when you've reached contentment? When you start asking questions like that, you find out that the idea of being in renewal is really just because it seems like a way to acknowledge a need to improve without speaking to, hey, I'm in denial about what's really at issue, or I'm confused on what to do. Most people in any endeavor, almost all of you who are going to be looking and working through this course are going to be in these 2 rooms. You're either in denial about what's possible, you're in denial about what works or what doesn't work, you're in denial about if you have what it takes, or you're confused about what to do next. One of these 2. And if that feels dark, know that you've got company. Almost everybody, when it comes to some new endeavor, is in one of these 2 rooms. We find, actually, when you go back and do the research, that if you take the time from 0 to a completion of a task or project or outcome, that you will spend close to 80. Whoa, my drawing is off here. You will spend close to 80% of your time in these 2 rooms, and 20% of your time in these 2 rooms. Actually, you end up spending about 15% of your time in the renewal phase, which leaves about 5%. So, whenever I start feeling content in my trading approach, I start going, man, what am I not paying attention to that I should? What am I in denial about? What do I do not want to recognize in my performance, in my approach, in my system? Because I just know that this model works, and it holds. And it could be a great one that you can use for yourself as a self-assessment. Again, to say, to know what stages are you on. If you're in stage 2, you say, okay, well, how do you know? how do you know that you're not in stage 1? You can poke at these and say, well, because I'm in, you could say, I know I'm in stage 2 because I've gone through and I've seen all the things that I don't know, and I've made a list of what those things are. Now, I don't know what to do about those, but I've identified some things that are out there. Well, that's taking you out of denial and bringing you into confusion, right? So then you go, okay, well, I know what I need to work on. And I grab the Build a Profile course because that's going to help me build a foundation, right? So that's removing the confusion, and that's moving you into the renewal room. It's a way that we can use these tools. And this is the non-sexy stuff. I know people want to jump in and start looking at charts and coming up with strategies. And I will tell you, from having seen just about every side that there is to this industry, all of that other stuff is smoke and mirrors. People who are really successful think out as a total game and a complete and holistic approach. And using tools like this are absolutely crucial toward your success. Okay. Now, how's this course going to work? And how, because I really want you to be able to get as much value out of it as possible and as quickly as possible. Now, when I say quickly, I mean, it's not going to be an overnight thing. By the time it's said and done, these 12 modules are going to be close to 20 hours, which is not a small amount of time. It's quite a lot of time. But that's because the task at hand is a difficult task. Trading, being successful in markets and investing is not something that you're just going to pick off the street. If there's somebody that you're listening to that says that it's easy and that you just got to follow these things and you'll figure it out, I'm sorry, they're lying to you. Anything of value in any endeavor is never easy, and this is no different. So how does this course work? Well, one, go at your own pace. You're welcome to go as fast or as slow as possible. Now, I spread out the recordings for each module at least a day, because I want you to be able to, at least have a moment to digest one of them before you go to the next one. If I give you all 12, I know it's often what happens is someone will go jump, to module 9 because they think they don't need the other, the 8 before that. That's not helpful. There is a progression here. So, but go at your own pace. And if you want to spend a week on module 1, spend a week on module 1. Spend as much time as it is to feel like you have a mastery of the concept, and you can go on to the next one. Second, watch this video for each module. You get these, they're yours. You can go back and watch them as much as you want. Watch them, make notes, try different things. Complete the exercises. With each module, we've got exercises and homework for you to do to enhance your learning and understanding. I can share a concept all day long, but if you don't go out and practice this stuff deliberately to try to build a foundation skill, it's not going to be successful. You actually have to go out and actually do this. And we're going to break this out and pace this in such a way that's very attainable, even for somebody who's got a busy schedule. But encourage you to complete the exercises. And then once you've completed the exercises, go to the next module. And then finally, if you run into help or run into questions, something's not clear, you need help, just reach out, and we're happy to help you along the way. Remember, nothing will work unless you do. I want to say that at the front end. This course, we're going to do our absolute best, and we're going to give you some incredible tools. I mean, I wish so much that I had something like this when I got started in markets. I would get years back. I would erase lots of mistakes that I made along the way that I had to learn from the hard way. I'm really trying to save you from those. Some of those are very, very costly, but nothing will work unless you do. So if you're willing to do the work and you're willing to take the steps and you're tired of things that don't work and you want to build from a foundation that's solid, that will not be tossed back and forth by every wind that's going to come along, then we're going to have a whole lot of fun. So let's get started, shall we? Module 1, are you a trader or are you an investor? The objective for this module is that after considering the options, you would know which is a better fit for your personality and makeup, your capital, and your goals, investing or trading. And I do see these as separate, and I want to define what we mean by trader or investor. Okay, an investor is someone who is highly capitalized. They are looking for fewer opportunities. They want to beat the benchmarks. So, if the benchmark is the S&P 500, they want to beat that, or if there's mutual funds out there, they want to beat that. But they really desire to have a more passive approach to investing. They want to identify a few opportunities, and they want to park money somewhere that years down the road, they've built a portfolio that's going to either generate income or generate wealth for them that really gives them an opportunity to make decisions at a much slower pace. Sometimes the duration of the positions could be years. It could be decades, depending on whether stuff works quickly or not. But this is when I think of an investor. This is the type of person, and you can do this either you can do it investing in businesses, you can invest in properties, but you can invest in markets. And by building a portfolio of specific trading products that you intend to hold, and that those ultimately generate wealth and income for you. Okay, and then there's a trader. So a trader is someone who has less working capital. They're looking for multiple opportunities. They want to compound gains. Benchmarks are not enough. Benchmarks are boring for a trader. A trader specifically doesn't want to have cash tied up as the investor does. The investor has money that's just, well, maybe a large sum is actually parked somewhere and it's not very liquid. It's in, a trader wants to keep things liquid and turning over and over and compounding. Opportunity for the trader trumps holding. So, if I'm locked in opportunity as an investor, that means I'm missing out on other opportunities that come along, and the trader doesn't want to miss out on those. Position duration for a trader could be minutes to months. Sometimes they're longer than months, but often when I think about a trader, I think that they're in a tighter duration. And for most of you who are going to be taking this course, unless you're highly capitalized, and when I mean highly capitalized, I'm talking about somebody that I would call a qualified eligible person of $1 million net worth or more. Okay, this is someone who has a lot of free capital that they can go park somewhere, and they can identify a few opportunities and let it build and ride the cycles that occur. If you're looking to actually build something like that, or you want to be more active because you have less capital, trading is one way to go. Both, it's in some ways it's the difference between somebody who requires a property portfolio and somebody who flips houses. Okay, the investor would be the person who's methodically adding properties to their portfolio, while the trader is trying to find the undervalued house in the neighborhood, fix it up, flip it, and make a quick profit. Okay. Now, both are chasing yield. The question is how much yield, and how much time do you have to watch it? This is the idea. And I can't answer that question for you. I mean, it's one that you're going to have to answer for yourself. I personally, I'm in both spots. I've got plays in both. Most of my investment plays are in businesses that I have ownership stake in, whereas I'm identifying active opportunities. I'm doing that as a trader. Now, opportunities are different. They're also different risks. So I want to talk about some of the risks that are involved with whether you're a trader or not. One, there's product risk. If you're locked into a specific portfolio position as an investor, there are things that can impact the value of that holding. It could be a liquidity. What I mean by liquidity is it means that there are a lack of people willing to exchange this product. And when that happens, prices are very erratic. And so you may want to get out at X price, but the only available price is Y price, and that's not advantageous. So there's risk there. That risk can also impact traders. Margin is a risk around the specific products that you have. And margin, as we'll talk more in future modules, has to do with how much cash you have to have tied up into a specific position. And some positions that I have, if I want to hold them, I have to actually pony up more money to be able to hold those. And then there's also specific product or news risk that's could be impacting this. When we talk about commodities and foreign exchange and stocks and some of these things, you can have earnings reports that impact the stock value. You can have economic reports that impact the price of a commodity. You can have central bank influence that impacts the relationship of two foreign currencies to each other, and in wild ways that you can't control. So know that there are risks out there either way, whether trading or investing, and the time frame upon which you meet that risk is different. Economy risk on the investment side, think about this. If you have and hold a product or a holding in an investment, there are cycles where economies do better than others. One of the things that we're watching right now, and we're coming around the beginning of 2018, is we're watching yield curves, which, you know, for some of you that may mean nothing, but it has to do with the distance between the yields or what people are willing to pay for short-term debt. You know, there's different expirations of debt, you know, on those interest rates. The tighter that is, that's often a bellwether of, you know, some economic headwind. And we don't need to know much except for the fact that there is, you know, waves economies have. They don't always go up. They don't always go down. They have waves. You know, if you ever talk to somebody from Merrill Lynch or Schwab or Edward Jones or Northwest Mutual, you know, one of those guys will always tell you is when you get started, if you're trying to, you know, fund a 401k or some kind of IRA or some, you know, product, some investment product, the idea is that you're going to hold this thing for some time until the future. They'll say historically, and they're not false when they say this, that if you hold something for at least 10 years, there's a 95% chance that you will make a gain. If you hold something for 10 years. So if I hold a, you know, mutual fund, if I hold a stock, you know, there's a 95% chance historically, as long as these things have been around, that I'll make a gain. Now, it doesn't say how much of a gain. All right. If we just look at, you know, if we just look at markets, you know, actually, if we let's just look at a market. We're going to look at the S&P 500 here. So let me pull this over here. Okay, so let's look at each one of these little bars is 1 month. All right, let's mark 10 years and determine, you know, where is it that you got in? You know, if you got in, if the place that you got in was here in 2007, when was the next time that we saw those prices again? 2013, 6 years later, just to get back even. All right, now they've appreciated since then. What if you bought in 1999? When was the next time that they got to those prices? They got back to them. They were above them for a little bit, right? But then underwater from 2001 all the way to 2007. So the cycle upon which, when you get in, you don't know, I don't know, you don't know, you know, where this is, but these cycles can impact, you know, how those holdings do, and that's a risk to be aware of. Okay. It's one of the reasons why I have, you know, stuff that I'm investing in. I'm also actively trading because, you know, while I have some things that are in, you know, that could be exposed to cycles of an economy risk, when I'm trading, I can be in and I can be out. Error risk. Now, this impacts more the trader than it does the investor. But, you know, if you have more transactions, there is a greater chance that you will commit an error. An error could be placing the wrong trade, wrong product, wrong time. You put in order you didn't think you put it in. You didn't put an order in that you thought you put in, and then you're in a position when you thought you're out. These are the types of things that can impact and be a risk to be mindful of. So when you're in a position or out of position, it's almost like being around a gun. I always treat the gun like it's loaded. Even if I'm convinced that it's not, I still treat it like it's loaded. When you're trading, and I treat that account as if it's loaded. So I'm always checking: am I in a position? Am I not? Do I have standing orders? Do I not? You know, what's going on in there to reduce the error risk. And then finally, there's a performance risk. And the performance risk can be cyclical in the sense that you can find an approach that will be effective in certain market contexts and behaviors that will not be effective in others. I know there are lots of hedge fund managers who build approaches based on trend following, that they identify a trend and they get on the trend and they just ride the trend. Okay, it can be very effective in markets that are trending. If the market is not trending and the market is choppy, their performance just absolutely craters. Okay, so knowing which type of environment that you're in can certainly impact performance, and it's a risk to be aware of. So, you know, this is one that I didn't know that I didn't know when I first got started. But, you know, given that there are cycles of the market, There are certain indicators that are bellwethers of my performance. One of those is, I trade NASDAQ futures, which we'll talk about in a future module. I'm very effective trading NASDAQ futures when the volatility of the NASDAQ, the VXN, which is a measurement of volatility in the NASDAQ. We'll also talk about what volatility is and what we mean by that. But when that number is above 15, I'm very effective. When it's under 15, my performance slips. So I've learned that if it's not above 15, I just don't trade it because I have less edge. I know that I have performance risk when it drops, or I get far more picky about the opportunities I look for. And that's cyclical. That volatility is cyclical. Now, those are some of the downies, the Debbie Downers. Let's bring it back up again in terms of talking about what's possible. What is possible, given that there are lots of myths around there. One is that there are outside gains above benchmarks are absolutely possible. If you look at what the S&P did this year, 20%. I mean that's an outstanding year in the S&P 500. I mean maybe one of the best ever in terms of gains. That is an outsized year for the S&P. That would be a low ball year for an active trader. And one of the things that was really attractive to me is I would look at, when interest rates being really low, I'd look at my savings account, or I'd look like a CD, place where I had parked money, and I go, oh my gosh, or I had a mutual fund. I did 10% a year. I'm killing it. All right. As a trader, 10% a year is absolutely not inspiring at all. It's what's inspiring to me, a killer day for me, I'm doing 1% a day in my account. There are 252 trading days a year. A good day for me is 1%. Now I don't always make 1%, and some days I get percents back. But it is very doable when you're quite competent, you know what you're doing, to see years where you're doubling your account or more. And while not being very active. Okay, so now you'll see hedge fund managers that will report gains. They're around 10 to 15% a year, and you'll go, okay, well, why are their gains at 10 to 15%? And you're saying, hey, you can do, 50 to 100, sometimes more than that. The reason is how much you're moving around. Think of the difference between an aircraft carrier and a PT boat. Okay, if I had $1 billion fund, and if the day that I get to, I'm managing $1 billion, I'll have this problem too. Whatever move I make, because I'm trying to chase yield, when I try to make them, it's hard for me to hide my moves. In fact, there's reports out that are generated weekly by the CFTC, which is one of the regulatory commissions, that reports on the size of positions that are held in certain products. So it's just harder to hide. And when it's harder to hide, it's harder to move. That impacts performance. But, if you're trading far less than $1 billion, you can be very active and can move in and out and around and not impact the market and see significant outside gains that you'd all be, absolutely pleased with. So, when we talk about what's possible, incredible things are possible. It is absolutely possible to generate wealth and or income through trading. And one of the things that is really attractive to me was the idea of I have something that's a little more economy proof. There are industries out there and businesses that people get into that when they jump in, they do well when the economy is going in that direction or that market sector is going well, and when it's not, they're in hurt mode. And I wanted to be involved in something that could appreciate and gain whether markets went up or down. And trading allows you that opportunity. There are actually products that you can establish positions in that will gain in value as the price depreciates. Okay, we're going to talk about that, how to do that, what those products are. That's a game changer. I came from a school of, well, the only way that I make money is if things go up. Not true. There's ways to do this in both directions, which actually adds to a healthy marketplace. the ability to do that in both directions. So let's talk about some of the products that are possible. Okay, let's talk about some of the products that we would look for these opportunities in to go after what's possible. And here, while there are more than what I'm going to list here, this is a good place to start. Okay, many people know about trading stocks. A stock is an instrument, it's a financial instrument that companies use to raise capital, to finance their operations, to unlock value. If an initial public offering, when a stock is first listed publicly and people can buy those shares of the stock, that is actually taking money to the company that can help them fund further expansion. So that's often where the founders make money, is when you go to an IPO. That's when the Mark Zuckerbergs become bazillionaires, is when Facebook goes public, okay? And then you can continue to trade these products, and the price will change based on the perception of how the company's doing, okay? And that's done in shares. I buy shares of a stock, and however many shares I want to buy, whether I want to buy 1 share or I want to buy 1 million shares, I could do that, and those shares are priced based on the current market value. Okay, I actually had the first stock that I ever traded. I had a friend who was a big fan of Apple computer, and for his birthday, a friend and I bought him 1 share in Apple stock. This was in 2000 that we bought this share, and we paid $25 for the share, which now has split 4 times and is worth someplace in the ballpark of $5,000. I think today that may be like the absolute best trade that I ever bought. But you can just buy 1 share of stock. If you're going to trade, you're going to most likely do more than 1 share. You're going to need to do them in what we call lots. But if you're looking at shares, another product that you can trade is something called an option. So an option, which we talk about as contracts, and so when you establish a position, you're establishing a number of contracts. And those are often in lots. Like a 10 lot would be 10 contracts. But a option is a coupon that gives you the opportunity to express an opinion on the direction of a stock or another product that we're going to look at called a future at some point in the future. And they are very attractive. I've traded them and enjoyed them. They can be a cheaper way to be in markets, which we're going to talk about how do you establish positions here in just a second. Those are stated in contracts. Futures are another product. Like options, futures are what we call a derivative product, meaning that they're based on some underlying product, and they're a way for you to express an opportunity at some point in the future that you want to take some action some point in time in the future. You want to have some option, or you want to do something in the future. And these are stated in terms of contracts. You're acquiring contracts, not shares. Okay. And then finally, there's Forex. Forex, which is short for foreign exchange. It's the idea that you are leveraging the difference between 2 currencies. They are stated in terms of pairs. So you're looking at a currency pair, whether it's the euro versus the dollar, or the US dollar versus Canadian dollar, or the US dollar versus the Japanese yen, but they're stated in pairs. They're also traded in lots, which we'll talk about as well. But these 4 product classes represent all of the big liquid markets that you can look at, and you can trade just about everything that there is on the planet expressed through these 4 products. Now let's talk about trading times, as this can impact which product that you desire to trade. Now stocks have 5 sessions a week. So whether you're in the United States or you're in Europe or Asia and working on a specific exchange, there are set sessions upon which you can purchase these products and you can trade them. You can invest in them. And so if you're not in that session, there's nothing to be done. And there are 5 sessions a week. In the United States, we're looking at Eastern Standard Time for stocks, everything based out of New York. We're looking at 9:30 Eastern until 4 p.m. Eastern is the trading day, Monday through Friday. Options, similar to stocks. We have 5 sessions. They trade at the same times that stocks do. Actually, caveat, stocks can actually have what we call an extended session, where they actually will trade for a little bit beyond that session. But often it's not as attractive. The options have 5 sessions a week that you can trade those. Futures trade 24/6. So they trade from Sunday evening until Friday afternoon, and they don't stop between from Sunday until Friday, with few exceptions. There are a few pauses that occur throughout the week, but most of those products are trading 24/6. And then finally, foreign exchange, similar to futures, can trade 24/6. So depending on what time you have to look at markets, what country you live in, where you're at, you can trade and pick products that fit your lifestyle and your time. You could work a full-time day in the United States. You could come home and you could trade Asia, which it comes online about the time most US workers go home for the day, and you can trade the active Asian session. You could be living in Asia and you could trade Europe or the United States, depending which one that you want to do. These are options that you can do, and you can establish accounts that give you access to those specific exchanges so that you can trade in those time frames. But these are the 4 main asset classes and the trading times around them. Now, one of the questions that I often get asked is capital suggestions. So like, say, you want to be active in opportunities. How much cash do you need to be active? And while you can open accounts for far less than what I'm going to tell you, I am going to give you a recommendation on an amount of capital to have to give you at least a decent chance of getting started. And the reason for that is, imagine that you were trying to jump without bending your knees. So, stand somewhere and try to jump without bending your knees. And you can't do it. I mean, you might be able to swing your arms and maybe get a little bit of lift, but the way that you really get height is actually bend your knees. How this applies to trading is that you put on a first position, you don't know if it's a winner or a loser. Nobody does. Or that you put the position that actually ultimately becomes a winner, but when you first get in, often when you first put a position on, you're not going to be right away. So you're going to take on a little heat. We're going to talk about how to define how much water we'll take on the ship before we bail. But as you're looking at these positions, I'm recommending amounts that allow you breathing room to start small and also have the opportunity to be wrong. So if I was starting with a stock trading account, I would want a minimum of $5,000 in the account, in which I would probably express one position at a time. This would give me an opportunity to be wrong. It would give me an opportunity to recover from that and have some extra cash if I needed to potentially adjust a position. If I was trading options, options are cool. Options can actually allow you to be more active with smaller amounts of capital. It's one of the benefits and the attractiveness of options. I can do that with $2,000 or more. If I'm trading futures, futures are a very attractive product. We'll talk about that in the module when we talk about futures, but they require a lot of capital outlay. Some of those products, to initiate one position, you got to put out $5,000. Actually, some of those you have to put out close to $40,000 to put on one position, and there's some that are $500. But because of the nature of futures and how they work and how they operate, a minimum of $25,000 is what I'd recommend. And if you're going to trade Forex, again, you can open accounts with much smaller than this, but I'd recommend $5,000 to get started. Again, these are recommendations, and these would also be recommendations if you already had an approach that you knew worked. Let me state this again. These are recommendations if you know. So this is a stage 3 competency. You know that you have an approach that will work. Then these capital levels work. If you have no edge, if you're stage 2, you don't know what you don't know, or you're aware that you don't know something, then you're going to need far more money than this because you'll burn through it. So aside from looking at these capitalization levels, the other thing that I recommend is don't trade anything live until you know that you have the capability. Paper trade. There are lots of ways to be able to, trade as if you were trading the real thing, to give you practice and to ensure that you have a skill without putting the risk out there. Eventually, if you're going to be successful, you're going to have to cross over and start trading live. But until then, don't put live money on there until you know, hey, I've got edge. It's going to be hard enough once you are confident that you have a system that's going to work to put live money on the line. Don't add the additional pressure of live money and I don't know if it's going to work. That's a recipe for disaster. Right. Cash, what's required to establish a position? If it's stocks, it's the share price plus the commission. Or there are some brokerages that it's just a share price and they basically will say it's commission free. They are still charging a commission. They're finding that in the spread between the bid and the ask, and they're not going to let you trade for free, even though they market it as that. They're just not. They're being a little more creative around that. So, for example, if I find a stock and it's $100 a share and I want to buy it, it costs me $100. If I want 100 shares, then 100 shares times 100, $10,000, I can get in the position. Or if I have a commission on top of that. Options would be the contract price plus a commission, and because an option controls it's what we call a leveraged instrument. So it means that it has a power that's greater than what you're investing in. When we'll talk about leverage and why that can be very attractive, and that can also be very risky when we talk about trading options specifically. But it's going to be the contract price plus the commission. Futures, it's the contract margin. Futures are an interesting animal because you're expressing risk against some underlying product, and it is also a leverage thing like options, where you're actually having to just put up money as a guarantee to establish a position, and different contracts or different products have different margin requirements, but it's going to be the margin requirement plus the commission. And then Forex is going to be the pair margin, and that's set by the different brokerages based on how much leverage that you have. So you can always check and say how much. The term that we use is buy power reduction. So if I have X number of dollars, if I had $100,000 in my account, if I try to put this position on, how much buy power is going to be reduced from that 100K to put this position on? That's the question to ask. Okay, so that's a high level of the different products and some of the risk. What I want to do to land this module is to just talk about real briefly, well, how do I win? How do I win in markets? Whether I trade stocks or options or futures or Forex, how do I win? Well, I think that winning, and I don't just think, I believe this and I've experienced this, comes from orienting around this concept. And that is that businesses excel when they can see opportunity and capitalize on it before the opportunity is gone or identified by others. By the time the trend has developed and everybody sees it, it's too late. Right now, and this will date this course, but right now everybody's talking about Bitcoin. Oh, Bitcoin, and all of these cryptocurrencies, and they're very exciting products. But when you go to the dentist and your dental hygienist is talking about her husband has bought Bitcoin when she finds out that you're a trader, that's telling me that everybody can see the opportunity. So then I don't think there's that much opportunity left. When I see specific types of businesses pop up in a community, the community that I live in, we are known for microbreweries. And we're like peak brewery. There are 23 breweries in a city, 165,000 people. How many more breweries are you gonna have? You'd have to have a killer idea to have a new brewery and have it succeed. And in fact, that's what we're experiencing, is that people try to open a new brewery because that's been the hot thing, and they're finding it ain't working. And the people who are opening late are making far less and actually going out of business with loss, as opposed to people who got into it 10 years ago or 15 years ago. Those were the ones who saw the opportunity before it became realized. They saw it when nobody else could. That's who wins. If you're going to win in markets, you're going to have to identify opportunities that nobody else sees or a few people have seen. It's something like this. If this was a product adoption curve, I mean, this is a market opportunity curve. You know, there are people, the innovators, they're the ones who are like, they are the contrarian. They're, you know, whichever direction the market's going, they're going against it. Now, that person's often wrong. And I'm not advocating going with the contrarian, but I am advocating that you pay attention to the early adopters. The early adopters and the first slice of the early majority, okay, in here, that's where we want to be. That's where we can see an opportunity. It's not fully realized yet, and there's not a lot of people that have jumped on that. We want to identify that, and we want to go with them. It's great to be with the early adopters and early majority, because I know that there are other people with me. If I'm just in innovator land and I'm selling against the wind, I'm going to be alone. I'm going to be in lots of pain. And you will doubtless find people on CNBC and Bloomberg and Twitter and, you know, FinTwit and all this different things who will you know, talk about how, you know, well, the market can't do this, it shouldn't do this, and all this kind of stuff. And, you know, the louder they bark about the market and what the market should or shouldn't do, they're most likely out here. And that means that they're most likely experiencing pain. They're going to, you know, there are times that they'll be right. But, you know, that's not going to be the majority. So as best you can, shut them off. And we're going to look to see how we can be here. That's how you win. That's how you win in markets, is to be there. Okay, so additional important considerations for yourself as you're thinking about this. One, how much time and money do you have to work with? I don't know. Only you can answer that. And know that success requires trade-offs. So, you know, to be successful in this, you're probably gonna have to give up time somewhere else. And is that time that you want to give up? You're gonna have to weigh that out carefully. KISS, keep it simple. It's very, very easy in this industry to cobble on and add all kinds of stuff to your approach and methodology that will absolutely just crater your performance. We're going to focus on keeping things simple and as stripped down as possible, and you're going to find that that's going to serve you much better than adding all kinds of, oh, well, there's this, you know, this indicator and this system and this setup, and, you know, when all of that stuff often does not work. Makes your screens and your charts and your analysis just look like spaghetti. Keep it simple. Keep it simple. Find a product that works for you and keep after that. Once you've found your style and edge, patiently wait for those conditions to arise. I was having a conversation with a trader just yesterday, and he says, you know, I'm experiencing this thing where I'm having, you know, just like feels like I'm this slow drip out of my account. What's going on? And I was like, man, you know, every time that's happened to me, I've been forcing trades or I've been over trading, meaning I'm bored. So I'm just trying to create ideas instead of waiting for the ones that I know are like a, you know, big pile of money over in the corner. And I just wait for those. Then I can be active, then grab the pile out of the corner and go on and wait for the next one. But that's not the tilt. Most people want to be too active, and this is the thing that diminishes their performance. Now, at a stage 2 competency, you don't know how much is too active. You may think, oh, that's exactly how active I want to be, and you don't know how active to be or not be. And we're going to try to build some frameworks around that to help you know, hey, this is a reasonable and manageable approach in terms of activity. But once you've landed on your style and edge, which is going to be unique for different traders, based on your interest and your personality and other things you got going on, you know, the discipline comes to wait for those conditions to arise and go after it. I mean, I can tell you there is a trade that occurs almost every Wednesday in crude oil futures. I could build an entire business on just trading every Wednesday at 10:30 Eastern crude oil futures. And I wait for that trade every week. Now, you know, I trade others, but I mean, I could, if I wanted to, just trade then. That'd be it. This one. If you find that you use words like play or gamble when you think about markets, you're like, oh, I'm gonna go play the markets. Well, it's just a gamble anyway. Then quit now. Quit now. This is not for you. If you approach it like this, like it's a game, like it's something that has the same odds and ability as if you're going to the casino, then just set an amount of money that you want to lose and go to the casino. I guarantee you'll have more fun. Fair enough? What we're trying to build and what this course is designed for is to give you a foundational degree of competence that you can build on and be successful as you want to be. We're going to give you as good a foundation as possible. But if you're looking at it as something that you play or gamble or that's going to be easy, then you're in the wrong spot. Now, there's lots of stuff about Henry Ford that I don't like. but one of the things that I like is this quote. I absolutely agree with him here. You know, whether you think you can or you think you can't, you're right. The realities that we experience in life start with how do we believe? You know, what do we believe is possible? What do we believe about ourselves? What do we believe about we're capable? They start there. And I also know, as a lifelong Packer fan, that perfection is not attainable. But if we chase perfection, we can catch excellence. There are no 100% effective trading systems. So if you've been looking for something that's going to mean that you'll never lose when you put on a trade, then let this be the wake-up call. It doesn't exist. It does not exist. I mean, think about this. Think about any great professional baseball player. Ted Williams, one of the greatest bats ever. You know, what was his batting average? 400? It means he averaged 4 out of 10 he got a hit. And Michael Jordan, this is, you know, 3-point shooting percentage, like 30%. You know, Steph Curry today. I mean, these guys are not 100%, and yet we look at them with awe, right? You actually don't have to be right every time to win if you have a good system and approach. That being said, we're not trying to lose. We're trying to win. And we're just keeping that in the context of perfection is not possible, but excellence is. So we're going to approach it with the desire for excellence. Okay, some initial tools that I want to put in front of you, and let's talk about your homework. One, these are free resources that I use and I used to go to all the time. Investing.com. Go there. If you have a Facebook account, you can create an account on investing.com. This will be helpful because we can actually start building some watch lists and look at specific products. They have some really good economic calendars. It's all free. Won't charge you anything for that. And it'll give us an ability to look at some charts where we're all looking at the same stuff. So investing.com is one to have in your toolkit. Another one is Investopedia. This is helpful. I remember, you know, on the institutional side, I'd be in meetings, people would talk about specific things, you know, like exchange for physicals and swaps and all the, you know, the different things. I had no idea what this stuff was, right? I could actually go to Investopedia and it would describe for me. It's a great encyclopedia for investment trading knowledge. Go check them out. Finviz. Finviz.com is another website that you can go and you can actually run scans on specific setups and conditions to, you know, narrow your search around stocks and futures and Forex. And then finally, stockcharts.com is another free resource where you can actually go and look at specific ways that you can set up charts. And why this is helpful is that there's lots of ways to organize information and really organize, you know, how we're looking at price, which that's what we're going to talk about in module 2. Is going to talk about, you know, price in these products and how do we organize what's happening in price to make decisions. Stock charts can give some great options there for how to organize that information. Those are some free resources. Go check those out. Investing.com, Investopedia, Finviz, and Stock Charts. And then homework. This is an internal one. I can't answer this for you. Only you can answer this for you. But one is this, you know, this this degree of being enamored with this idea of this opportunity. Is it a fad or is it a passion? You know, is it something that you're just like, you're interested for a little while and it goes away, or is it something that you're just like, oh my gosh, I love it. So I think about, I'm a junkie. I can't get enough of it. That's more on the passion side, right? Success is more tied in this to being on the passion side than on the fad. Just, that's for free. But another one, do you have the support of your friends and family? Having a good support system is crucial because markets are hard. And if you don't have someone who can be around you and rally you when you have bad days and celebrate with you when you have good days, you're going to struggle. So having a community around you is important. How much free capital do you have? And what I mean by free capital is this is capital that if you lost it all, it's not going to hurt you. Even after you practice and you feel like you have an edge, you start putting money on the line. Is that money that you can lose? Going and taking out a second mortgage on your house so that you can trade is not a way to do this. You're ramping up the stakes too much. How much free capital do you have? And then how good are you at deliberate practice? Meaning, if there's an objective or outcome that you're searching for, how good are you at meticulously going forward and building, towards the goal? Or do you find that you start things and then you stop them, and you don't really, you might learn a little bit about them and then, you go from there. This course is a form of deliberate practice. If you go through all of the modules, we're going to do deliberate practice. And I told you earlier on, I was talking about this kind of 20 hours. The reason for the 20 hours, if you've read Malcolm Gladwell's book on The Tipping Point, he references 10,000 hours as a level to strive for. Well, that's 10,000 hours gets you to be a top performer in a highly competitive field. But in 20 hours, as Josh Kaufman talks about in his book, The First 20 Hours, you can go from having no knowledge of something to being fairly competent. So over these 20 hours, we're going to take you from, hey, I don't really know a whole lot, to I could talk in an educated way about these things, and even begin to act on them. So we're going to, I know everybody's busy and it's hard, but if you want to be successful, you can. It's going to take some deliberate practice. And then last step is just to go and create an account at investing.com. We're going to reference that in the future. I don't get any kickbacks from investing.com. It's just a free resource that's out there that I use personally in my trading, and it'll allow us to kind of accumulate some stuff as we're going without you opening accounts and doing other things. Okay, those are the homework steps. Next steps: review the video, complete the homework. If you're part of the group option for Build a Profile, you're free to discuss the content of the module with other students and the facilitators in Slack. If you're not, then just keep working on it on your own, and then proceed to Module 2. If you get stuck and need some help, send me an email, give me a call. We're here to help, and if we can do so, point you in the right direction. The answer may be, hey, that's a great question. We'll talk about that in Module 10. Or, hey, that's a great question, and that actually comes in other things that we do past this course. It's outside the scope of this course. We'll tell you that to kind of give you an idea of where you go. Or we may say, hey, that's a great question. Here's an answer. It could be any one of those. Okay, that's Module 1, everybody. Good start. Only 11 modules to go. Trade well, study hard, and we'll see you in the next module. Peace.